Turkey has just offloaded 58 tons of gold in only 2 weeks. At the same time, major Gulf sovereign wealth funds are quietly pulling bullion out of London vaults. Moves like this? They haven't happened on this scale in nearly 70 years. Now here's where it gets even more interesting. While gold is being dumped, oil prices are pushing higher, cutting through resistance levels like they're not even there. And somewhere in the background, two overlooked industries, barely mentioned on mainstream financial media, are suddenly attracting massive amounts of capital. So the real question is, what do they see that most people don't? Because if you can understand what's actually driving these shifts, you're not just reacting to the market, you're positioning yourself ahead of it. And setups like this? They don't come around often. They're the kind that can shape an entire portfolio for the next decade. Ignore it, and you might find yourself watching from the sidelines yet again. But stick with me for the next few minutes, and I'll break it all down for you. Why this gold sell-off might actually be an opportunity, which two hidden sectors are quietly absorbing smart money right now, and the exact framework institutional investors use before the crowd even realizes what's happening. My name is Felix P. I'm a former investment banker, and this is where things get interesting. All right, calm down. Sit tight. You can't see him, but Winston is back there. And yes, he's not too happy about gold dropping right now. He's our resident gold enthusiast, and let's just say, this isn't his favorite moment. Together, we're also the founders of Gold Academy, where retired Wall Street professionals teach everyday investors the strategies typically reserved for institutions. Over the past 6 years, we've worked with more than 20,000 people, something I'm incredibly proud of. I'm also a co-founder of Trautemission.io, a tool we'll use shortly to highlight some of these opportunities. And honestly, my mission now is simple: to give regular investors access to knowledge that used to be locked behind closed doors, because what we're seeing right now, forced selling in gold, a major oil surge, and capital quietly rotating into ignored sectors, this is exactly the kind of environment my mentors trained me to watch for. Let's dig into it. Now, I know some of you are here for one thing. Just tell me the two sectors. And I get it. Who doesn't want to find the next big opportunity quickly? But here's the truth. This isn't about getting rich by Friday. I will give you those sectors. I'm not going to hold them back. But if you really want to benefit from them, not just chase them, you need to understand the framework behind it first. Because this is exactly how Wall Street thinks. And it all comes down to 3 layers. Let's start with the first one. Layer 1, forced selling. This is when large institutions, think hedge funds, central banks, or sovereign funds, are forced to sell assets. Not because they want to, but because they have to. And here's the twist. Whenever I see forced selling, I don't panic. I actually pay closer attention. Because forced selling often creates temporary distortions, moments where prices move not because of true value, but because of pressure. And inside that pressure, there's usually opportunity. Now, just to be clear, I'm not a financial advisor, and I'm not telling you what to buy or sell, but what I am seeing right now is a significant wave of forced selling in gold, and even in silver, not because demand has disappeared, but because something else is pushing large players to liquidate. And that distinction, that's where everything begins. Demand disappearing. It's not that. What we're really looking at here is something temporary, something mechanical. Think margin calls, liquidity pressure, situations where big players are forced to sell, not choosing to. And that changes everything. So here's the next question. If that's layer 1, what comes next? Let's move into layer 2. Fundamentals. This is where things slow down and get serious. We're talking about long-term structural shifts. Not what's going up by Friday, but what's being quietly built over years. What forces are reshaping the global economy and where demand is naturally being created. Now here's where it gets fascinating. One of the two sectors attracting massive capital right now is being fueled by the chaos unfolding in the Middle East. Rising oil prices aren't just affecting oil, they're creating ripple effects across alternative energy markets. So ask yourself, when oil becomes unstable or expensive, where does the world turn next? That's exactly the kind of second layer thinking institutions use. Now let's go deeper. Layer 3, this is where things get exciting. This is innovation. And innovation doesn't move in a straight line, it moves in waves. Big surges followed by adoption, followed by explosive growth. Picture that wave building, and then suddenly, boom, a breakthrough happens. A new technology, a new system, a new way of doing things. And when that happens, what does it attract? Take a second, think about it. Drop your answer in the comments if you already know, because the answer is simple: money, serious money. Institutional money. It always starts there. Big funds move in first, quietly, strategically. And only after that, it becomes mainstream. Retail investors arrive later, when the story is already everywhere. Now step back and look at all 3 layers together. It's like walking into a shopping mall where three different events are happening at the same time. A clearance sale, that's your forced selling. A major reopening, that's your structural shift. And a brand new store launch, that's innovation. Each one offers opportunity. But here's the catch. Most retail investors only ever notice one of them, usually the last one, when it's already crowded. So what if you could see all three at the same time? Because that's exactly what's happening right now. And if you've ever felt like these opportunities always happen for other people, and I only hear about them after it's too late, go ahead, type after in your mind for a second. That frustration? That's real, and this framework exists to fix exactly that. Now here's the turning point. If you're serious about learning how to take moments of chaos, war, uncertainty, market panic, and actually turn them into opportunity, then this goes way beyond just today's video that I'm hosting a completely free, in-depth training this weekend. For about 2 hours, I'll walk you through the exact structure Wall Street has been using for over 50 years to consistently identify these kinds of opportunities. Because here's the truth, institutions don't just show up on Monday morning and ask, what should we buy today? That's not how it works. They operate on rules, frameworks, systems. That's why they stay consistent, and why the biggest banks still exist. So if you want to learn how to think and position like them, you can reserve your free spot. It's happening Saturday at 8 p.m. New York time, and trust me, this isn't just about understanding markets, it's about learning how to benefit from uncertainty instead of being controlled by it. All right, now let's break this down step by step, because this is where things start to click. Layer 1. Forced selling. We already touched on it, but now let's go deeper. Turkey, yes, the country, not the food, just sold 58 tons of gold in 2 weeks. That's not a small move. That's one of the largest weekly drops in their reserves in years. And why did they do it? Not because they suddenly stopped believing in gold, but because they needed to defend their currency, the Turkish lira, during rising geopolitical pressure linked to the Iran situation. And here's the part most people miss. That single wave of selling actually exceeded total ETF outflows. Let that sink in for a second. But doesn't stop there. India has also turned into a net seller. Major Gulf sovereign wealth funds, think ADIA, PIF, and others, are quietly moving bullion out of London vaults. In fact, around 45 tons have been shifted recently, far above normal levels. Now, here's the tricky part. These Gulf funds, they don't announce their moves. They don't need to. Their actions happen behind closed doors, privately, strategically, often invisibly to the public. So what you're seeing on the surface is only part of the story. And when you connect all the dots, it starts to explain why gold suddenly dropped nearly 20%. But here's the key insight. Don't miss this. This wasn't a collapse in belief. This was a liquidity event. Think of it like this. Imagine a wealthy family going through a temporary cash crunch. They don't sell their assets because they've lost faith in them. They sell because they need immediate cash flow. That's exactly what's happening here. Countries are essentially selling a piece of their family silver to navigate short-term pressure. And once stability returns, they'll likely start buying it back. What does that mean for you? Opportunity. In my view, this creates a window in gold and especially silver. Now here's where it gets even more interesting. Gold and silver may seem similar, but they're actually driven by two very different forces. Gold, that's primarily investment demand. It's about wealth preservation, central banks, and long-term stability. Silver, that's a hybrid. It has investment demand and a strong industrial demand component. Ask yourself this: what happens to industrial demand during periods of conflict or global tension? It doesn't disappear. It often increases. And that's why silver tends to be more volatile, but also more reactive to global shifts. Yes, it's been hit hard recently, no question about it, but industrial demand? It's already strong. In fact, in many cases, it's outpacing supply from manufacturing. And speaking of supply, we're not seeing a wave of new gold mines opening up. We're not seeing massive increases in production. In simple terms, the world is tight on gold and silver. Don't take my word for it. Try buying physical metal yourself. Ask about delivery times. You might be surprised how long it takes. Now here's the institutional perspective. When forced sellers dump an asset onto the market, what usually happens? Prices drop, but not just a little. They often drop below their true value. And that's where smart money starts paying attention, because the long-term drivers for gold haven't changed. Central banks are still buying. Many major institutions project long-term price targets in the $5,000 to $8,000 range, and nearly 95% of central banks expect to increase their gold reserves. At the same time, the US dollar is likely to face renewed pressure, driven by rising deficits, defense spending, and ongoing shifts away from dollar dominance. And layer on top of that, geopolitical tension, war, Energy disruption. All of these forces, they don't weaken gold's long-term case. They strengthen it. Oh, here's the real question. If the fundamentals are still intact and the current drop is being driven by forced selling, what happens when that pressure disappears? Because that's where the next move usually begins. And at some point, all that cash flows back in. And when it does, the question becomes, where do we deploy it? And historically, the answer has been pretty consistent. Back into gold, back into silver. That's the core of my thesis. And nothing about that has changed. If you've followed this channel before, you already know this isn't new. What is new is the timing. Because right now, for a limited window, you're essentially seeing discounted prices, driven not by weak fundamentals, but by countries needing emergency liquidity. Now, does that mean you should rush out and buy? No, absolutely not. You need to come to your own conclusions, but if this perspective resonates with you, if it starts to make sense, then maybe it's time to start thinking differently about how you evaluate assets, whether it's metals, stocks, or entire sectors. And if you want to go deeper into that, I've put together a free live training this weekend. Consider it a small Easter gift, where we break down exactly how to approach markets with an institutional mindset. But now, let's move to the next opportunity. And this one might surprise you, because the next sector quietly attracting institutional money is coal. Yeah, coal. Now pause for a second. Does that sound outdated to you? That's exactly why it's interesting. Because while most people are focused on clean energy headlines, smart money is quietly flowing somewhere else. So the real question is, why? Coal? Why now? Let's break it down first. Energy economics. When oil prices climb, $90, $100 or higher, it changes the entire equation. Suddenly, alternative energy sources that were previously overlooked start becoming competitive again, and coal, it becomes one of the cheapest available options for power generation. Now think about this, major institutions, including firms like Goldman Sachs, are projecting elevated oil prices for the foreseeable future. And when oil, and even LNG, liquefied natural gas, gets expensive, countries don't wait around. They adapt, and often they fall back on what's available, scalable, and cheap. That's coal. Now let's look at real-world behavior. Europe, despite all its clean energy ambitions, is facing critically low gas reserves. And here's the irony. In many cases, it's now cheaper to run coal-fired plants than gas-powered ones. Yes, the same region that shut down nuclear plants is now ramping coal usage again. So ask yourself, what happens when reality collides with ideology? Energy security wins. Every time. And it's not just Europe. India, one of the world's largest energy consumers, is actively increasing coal output using emergency measures to offset oil supply risks. So this isn't theoretical. This is happening right now. And when you see multiple major economies moving in the same direction, that's not noise, that's a signal. Now here's where it gets actionable. You might be wondering, okay, but how do I even find opportunities in a sector like this? Because let's be honest, coal stocks aren't exactly trending on social media. And that's precisely the point. This is where tools and data start to matter. Platforms like Trade Mission allow you to surface sectors, identify leading companies, and track where institutional capital is flowing. You can literally ask, what are the top coal stocks right now? And instead of guessing, you get structured insights, watch lists, and even alerts tied to real-time market activity. Now again, I'm not telling you to go out and buy anything, but what I am saying is this. Coal, right now, is moving in close alignment with oil, and if oil stays elevated, what do you think happens next? Because this is how institutional investors think. They don't chase headlines. They follow cause and effect. And right now, the cause is clear. Energy disruption, rising oil prices, and global uncertainty. The effect, capital rotating into places most people aren't even looking. So the question is no longer, is this happening? The question is, are you early enough to see it? And just like that, you've got real-time alerts hitting your phone, keeping you ahead instead of catching up. Now, for those already using Trade Vision, you're getting upgraded automatically. No extra cost, you're grandfathered in. But here's the catch. For everyone else, there are only a limited number of early access spots left. This AI feature isn't fully public yet, but it's coming. And right now, you can still lock it in at the current price before it increases. There's even a free trial, so you can test it without committing. So ask yourself, how much time could you save if the research came to you instead of you chasing it? If that sounds useful, check the link in the description and secure your spot before they're gone. Now, let's zoom back out, because this story isn't just about oil, or even just about energy. It's bigger than that. It's also a steel story. Think about it for a second. Every bridge being built, every skyscraper rising, every military ship, railway, or infrastructure project, they all rely on one thing: Steel. And here's the critical piece most people overlook. You can't produce steel at scale without coal.so when governments increase spending on infrastructure, on defense, on rebuilding supply chains. They're not just increasing demand for steel. They're indirectly increasing demand for coal. Now pause and think what happens when demand rises but supply has been shrinking for years, because for a long time, coal has been treated like a no-go zone. Environmental pressure, climate policies, shifting narratives, all of it pushed investment away from coal.so capital dried up. New projects slowed, supply tightened, and now demand is quietly coming back while supply hasn't caught up. That's what makes this a contrarian opportunity. Not obvious, not popular, but potentially powerful, and many coal-related stocks are still relatively undervalued because of that perception gap. Now let's move to the second sector, and this one sits on the complete opposite end of the spectrum. If coal is the overlooked old world play, this is the future, biotech. This is layer 3 in action, innovation, the wave we talked about earlier. Because when breakthrough technologies emerge, capital doesn't hesitate, it floods in. And that's exactly what we're seeing. Venture capital funding into biotech has surged, jumping dramatically in recent quarters. Billions are being deployed into research, development, and next-generation treatments. Mergers and acquisitions in the pharmaceutical space are rising fast as well, companies racing to secure innovation before competitors do. And it's not just startups. Major global players like Eli Lilly, Roche, Merck, and AstraZeneca are committing massive capital toward R&D and manufacturing, that we're talking hundreds of billions being funneled into the future of healthcare.so. Ask yourself, why would institutions pour that kind of money into one space unless they saw something big coming? Because biotech isn't just another sector, that it's where science, technology, and capital collide to create entirely new markets, new treatments, new therapies, new billion-dollar opportunities. And here's the key difference: unlike coal, which is driven by supply and demand imbalances, biotech is driven by breakthroughs. Point one discovery can change everything. That's why it's volatile, but also why it attracts massive institutional interest early.so. Now step back and look at the full picture. You've got a forced sell-off in gold and silver creating potential value, a contrarian energy play in coal driven by global demand shifts, and an innovation wave in biotech attracting billions in smart money. 3 layers. Point 3 opportunities, all unfolding at the same time.so. The real question is, which layer are you paying attention to? Because once you start seeing the market through this lens, you stop reacting and start anticipating. What happened to it? Winston, come here. Yeah, he's not moving. He's officially boycotting this segment, and honestly, I get it. Because what we're talking about right now might feel contradictory. But here's the truth. There's opportunity in every market condition. And this could be a big one.so. Let's ask the real question, why now? Why biotech? Out of all sectors, why is this one attracting serious attention? It comes down to something most people have never heard of: the patent cliff. Picture this for a second. We're here today. Now fast forward to 2028. Between now and then, over $300 billion worth of drug patents are set to expire. Now think about what that actually means. The most profitable drugs that big pharmaceutical companies rely on suddenly face generic competition. And when that happens, revenues don't slowly decline. They can collapse by as much as 80% almost overnight. Let that sink in.so. Now imagine being one of these massive pharmaceutical giants, companies like Pfizer, Merck, and Bristol-Myers Squibb, that they're staring at a multi-billion-dollar hole in their future revenues. And here's the problem: they don't have enough new drugs in their pipeline to replace those losses.so. What do? They go shopping. They start acquiring smaller biotech companies, the ones developing promising new treatments. And here's where it gets interesting. This creates a massive transfer of value from big pharma to biotech shareholders, because acquisitions usually happen at a premium.so. If you're positioned in the right biotech company before that acquisition, that's where the upside lives. Now pause for a second. Is this random? Or is it predictable? Because in my view, this is one of the most repeatable patterns in market. Big pharma has a gap. They need to fill it, and the fastest way to do that is to buy innovation. Now, of course, the next question is, how do you even find these biotech companies? You can screen for them, build lists, analyze pipelines. There are tools that make this process faster and more structured. But remember, just because something shows up on a list doesn't mean it's a good investment. Everyone's risk tolerance, timeline, and strategy is different, and that brings me to something important. Don't skip this part. Biotech is risky. Very risky. That we're talking about a space where up to 90% of projects can fail. That's the nature of innovation. But that's only part of the story, because there's another powerful force accelerating everything right now. AI. Artificial intelligence is completely reshaping drug discovery. What used to take decades can now happen in a fraction of the time. What used to require thousands of researchers can now be done by smaller, highly efficient teams, and the cost dropping significantly by as much as 40% in some cases. So now connect the dots. You have a patent cliff forcing big pharma to acquire new drugs, AI making it faster and cheaper to develop those drugs, and a growing pool of biotech companies becoming acquisition targets. What does that create? Opportunity, but also volatility, because while the winners can be massive, the failures are frequent. So the real question isn't just, is biotech interesting? It's, do you understand the risk well enough to play the opportunity? Because once you do, you start to see why institutions are quietly positioning themselves long before the headlines catch up. This is not something for the faint-hearted. Biotech is exciting, but it's also volatile. You need to go into this space with your eyes wide open. Now, that doesn't mean there aren't ways to approach it more carefully. For example, instead of betting on a single small biotech company, some investors look at larger, more established names, companies like Johnson & Johnson. These tend to be more stable, with diversified businesses and existing revenue streams. But here's another question. What if you don't want to pick individual companies at all? That's where ETFs come in. Biotech ETFs like SPDR SP Biotech ETF, iShares Biotechnology ETF, and iShares US. Healthcare ETF give you exposure to hundreds of companies at once. So instead of trying to find the one winner, you're spreading your risk across the entire sector. Now think about that for a second. Would you rather bet on one outcome or position yourself across many possibilities? That's why broad exposure is often the starting point for many investors exploring high-risk sectors like biotech. Now, let's be real about something. Even with ETFs, this space is still risky. Clinical trials can fail. Regulatory approvals can be delayed or denied. Policies around drug pricing can shift unexpectedly. This is not a smooth ride. Biotech stocks can swing hard, both up and down. So any exposure here needs to be measured, thoughtful, and aligned with your personal risk tolerance. Now here's the bigger picture. Despite all that risk, the structural drivers we talk about are very real. The patent cliff forcing big pharma to act, the AI revolution accelerating drug discovery, and billions of dollars flowing into the sector. These aren't theories. They're active forces shaping the future of healthcare and creating opportunities along the way. So now, let me ask you, which part surprised you the most? You might have expected the gold and silver story, but what about coal? What about biotech? Which one made you pause and think? Because once you start connecting these dots, forced selling in gold, energy shocks driving coal demand, innovation waves fueling biotech, you realize something powerful. This isn't random. These are patterns that institutional investors have been following for decades. And when you learn to recognize them, you stop chasing the market and start understanding it. So as we wrap this up, remember the framework. Layer 1, temporary dislocations like forced selling. Layer 2, structural shifts like energy demand changes. Layer 3, innovation waves like biotech and AI. When all three align, that's when things get interesting. All right, let's bring this all together, because when you zoom out, the picture becomes very clear. Layer 1, the opportunity in gold and silver, a temporary dislocation. Forced selling. Price is under pressure, not because the story is broken, but because liquidity is tight. Layer 2, the structural shift. Oil holding at elevated levels, $100 or higher, and suddenly coal is back in the conversation. Quietly, unexpectedly, but very real. Layer 3, the innovation wave. Biotech continuing to attract capital, even in one of the most chaotic markets we've seen in years. Now pause for a second. How often do you see all three layers lining up at the same time? That's why, for me, these are the areas worth watching closely right now. Not because they're trending, but because they're being driven by forces most people aren't paying attention to yet. And that's where the edge usually is. Now, Winston, come on, man. This is your moment. Yeah, he's not having it today. 0.0 cooperation. Full protest mode. But that's all right. Because if you've made it this far, you already understand the real takeaway. Opportunity doesn't show up when things are comfortable. It shows up when markets are messy, uncertain, and misunderstood. So if you found value in this, share it with someone who needs to see it, because chances are most people are still focused on the noise, while the real story is unfolding underneath. And just as I was wrapping this up, something else caught my attention. Oil didn't just climb, it surged toward extreme levels. And at the same time, Bank of America released a report to institutional clients highlighting shifts happening beneath the surface of the market. So here's the question I'll leave you with. What are they seeing right now that the average investor still hasn't noticed?